In 1999, 2000, gold was under $300
per ounce.
Yeah. Now it's over 4,000. And the reason for that is we've debased the currency. We've created so much inflation. You need more dollars to buy an ounce of gold. Now, the stock market, the Dow is about 50,000. And in 2000, it was 10,000. So the Dow is up 5x, but gold is up more than 10x during the same period of time. So what that shows you is, yes, we created a lot of inflation to get asset prices to go up in nominal terms, in terms of dollars. But in real terms, priced in real money, priced in gold, the market is a lot lower than it was 25 years ago.
Lower?
Yes.
Not even...
Way lower. It's half of what it was.
Gold surging from under $300 to beyond $4,000 per ounce exposes the dramatic loss of purchasing power over the last quarter century. While nominal stock indexes like the Dow climbed fivefold, real equity values measured in sound monetary gold have actually plummeted by half. Peter Schiff, veteran global strategist and seasoned asset manager, highlights that decades of reckless monetary intervention are driving today's systemic affordability disaster. Central banks continually manufacture liquidity to artificially prop up over-leveraged markets instead of allowing healthy corrections. Looking forward, consumer price inflation is projected to accelerate to even more destructive heights, triggering a historic plunge in the US dollar as the Federal Reserve is forced to aggressively restart quantitative easing to bail out fragile credit systems. This inevitable monetary expansion will culminate in a devastating macroeconomic downturn, characterized by skyrocketing corporate bankruptcies and surging unemployment rates across the country. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Quantitative easing was inflation. And, the current chairman of the Federal Reserve, Kevin Warsh, he's correct when he says that inflation is a choice. And it's the choice that the central banks always make because it's the lesser of the evils from their perspective. I think it's actually the greater evil, but from a politically expedient perspective, it's better for the politicians to create inflation. So the policy following the 2008 financial crisis was to create inflation, which is what they did.
Yes.
And, when gold, if you look at the price of gold in 1999, 2000, gold was under $300
per ounce.
Yeah. Now it's over 4,000. And the reason for that is we've debased the currency. We've created so much inflation. You need more dollars to buy an ounce of gold. Now, the stock market, the Dow is about 50,000. And in 2000, it was 10,000. So the Dow is up 5x, but gold is up more than 10x during the same period of time. So what that shows you is, yes, we created a lot of inflation to get asset prices to go up in nominal terms, in terms of dollars. But in real terms, priced in real money, priced in gold, the market is a lot lower than it was 25 years ago.
Lower?
Yes.
Not even...
Way lower. It's half of what it was.
Wow.
And that's why, everybody talks about affordability. We have an affordability crisis because the government has destroyed so much of the purchasing power of our money. And they did that, to bail out the banks and bail out the stock market in 2008. They did it again during COVID, right? They printed a crazy amount of money in 2000. The Fed's balance sheet doubled in 2020. We flooded the economy with inflation. That's why prices really soared in 2021, 2022. Trump and the Republicans want to say, it was because of Biden. I mean, it wasn't because of Biden. The policies that created those price increases happened under Trump. It was, Trump's final year, 2020, when we had COVID. And that's when the deficits exploded with all these ridiculous government programs,
like what?
The purchasing power or protection PPP program, whatever PPP. It was, or the stimulus programs. But the Fed slashed interest rates back to zero in 2020. So we really primed the pump with a lot of inflation. There is a lag between the creation of the inflation, which is the expansion of the money supply and credit, and the impact it has on prices. So we created the inflation under Trump. It manifests itself in rising prices, mainly under Biden. But if you look back at a chart of the CPI and see when it really started to rise sharply, it was in the last 3 or 4 months of Trump. And then that continued. And it was accelerating even before Biden's first, bill was passed. And so even if Trump had served 2 consecutive terms, had he been elected president, would have had the same thing. Inflation had been just as bad if Trump had been reelected back then as Biden. And now I think it's going to be even worse, in Trump's second term than it was, under Biden's, because I think we're going to see this big drop in the dollar as the Fed has to really crank up QE again. Walsh said, inflation is a choice, and he's going to make that same choice. He's going to make that choice for the same reason that Greenspan chose inflation, the same reason that Bernanke and Yellen and Powell, they all chose it because the alternative was a crash in the stock market, a crash in the bond market, which we need, a crash in the real estate market, a severe recession, high unemployment.
We need it.
A financial crisis. Well, unfortunately, we need a lot of that stuff because the whole economy is screwed up because of years of artificially low interest rates, inflated asset prices. The economy is messed up by what the government has done. Right? Free market forces have not been allowed to operate. And so we have all kinds of imbalances in the economy, bubbles, misallocations of resources. There's been so many mistakes that have been made as a result of this bad monetary policy that correcting them, will involve a severe recession, bankruptcies, and a big increase in unemployment. It's going to be very difficult to fix what the government broke.
Every wave of systemic price inflation traces directly to central bank balance sheet expansion and artificial interest rate suppression. Slashing borrowing costs to zero and doubling the monetary base during crises floods the macroeconomy with excess liquidity, debasing the currency. While politicians routinely blame opposing administrations for escalating household expenses, aggressive price increases actually reflect the natural lag between rapid credit creation and broad economic impact. In fact, consumer price spikes were already accelerating rapidly before recent spending legislation even passed. Central bankers consistently rely on currency depreciation because printing fiat money serves as an expedient political shortcut to avoid systemic liquidation. This relentless credit expansion distorts capital allocation, sustains fragile debt structures, and deepens the national affordability crisis by eroding purchasing power. Now, let's get back to the interview.
We had a big problem back then. We have an even bigger problem now.
We do.
And it's, the same factors are behind it. But the mistakes that were made leading up to the 2008 financial crisis, the mistakes that inflated the housing bubble, were pretty obvious to me as they were being made. And they really started after the bursting of the dot-com bubble. And, also we had these terrorist attacks in 2001, and we had a shallow recession. And so the Fed under Alan Greenspan, who just passed away a couple weeks ago at 100 years old. Yeah. He cut interest rates down to 1%, which at the time was really, the lowest they've been in our lifetimes. We hadn't seen rates that low. And that cheap money is what fueled the housing bubble, because it enabled mortgage rates to come down. But also they developed these, teaser rates where, because rates were so low and the Fed had pretty much committed to keeping them low for a while and then raising them very slowly in quarter point increments. So lenders were confident that they could loan out money for 2 or 3 years very cheap. And so they were giving out these teaser rates where people could buy a home, but for the first few years, the mortgage payment was really, really low. And so that enabled people to stretch to buy more expensive homes or pay more for homes than they could ordinarily pay. And because interest rates were so low, everybody was, looking for yield. Everybody on Wall Street wanted yield. And what they were doing was packaging up these mortgages, securitizing them and selling them. And there was demand for them. And because there was all this demand on Wall Street for mortgages, mortgages were readily available.
That's
and
right.
people were able to buy mortgages. And people now, you could have nothing down, zero doc, liar's loans. There was all kinds of fraud in it. The government was guaranteeing a lot of the mortgages directly through FHA and indirectly through Fannie and Freddie. And Fannie and Freddie became the biggest buyers of the subprime market. And I knew this whole thing was a gigantic bubble. Now, I knew it was a bubble, for years. And even like, I rented some space. I had I had my broker dealer at the time, and I had just moved down to Orange County from the LA area, and I rented a lot more space than I needed. And so I was subleasing space. And my tenants were always mortgage brokers. And I could overhear their conversations, and it was just pure fraud. I mean, they were just having people falsify their income, and they were cutting and pasting, and because they were cold calling people and telling them, "Hey, we can get money out of your house. You could do a refinance," and they would inflate the value, and they would, there was so much fraud going on in the mortgage market, and I saw that people were being qualified for mortgages based on their ability to pay the teaser rate. And, forgetting about, what would happen if the rates, hit their normal level. And so I saw this going on, and I saw people, buying multiple homes, leveraging up their homes, and knew, okay, eventually rates are going to go up. The teaser rates are going to mature. People, and nobody was even using fixed rates. People were using adjustable rate, ARMs. So I knew that this was going to end badly. I knew that the entities that were securitizing or guaranteeing the loans, Fannie and Freddie, I knew they would go bankrupt. I knew subprime was going to blow up. That's how, it got involved with that hedge fund to short the subprime market, which, you can see if you're on YouTube and you look at Peter Schiff mortgage bankers, you'll see a talk that I gave in 2006. And in Vegas, it was the Western Regional Mortgage Bankers Association.
In 06.
And there were like 3,000 people there, maybe. And I had spoke the year before in 2005, which really was the peak of the housing market. And I was the only one there who was bearish on housing. And all the other industry bigwigs were, of course, very optimistic. And so they had me come back a year later because some of those bearish forecasts were starting to come true by 2006. So I came on, and the main reason I went is I said, look, I'm trying to raise money for this hedge fund, the short subprime. I'll come down there, but I want you to give me like a room so I can do a workshop and let me promote this workshop because I'm looking for clients who might want to, get in on this trade. And they said, okay. And so that's why I went down there. But you can watch the talk, and I completely lay out exactly what's going to happen. And it all happened in 2007. About a year after my conference or that talk is when everything blew up. But I pretty much laid out how everything was going to collapse, how subprime was going to blow up, how the housing market was going to tank. I said, all of these mortgage bankers, you guys are going to be out of work. And I was hoping, too, that more of these mortgage bankers would want to hedge their careers by getting into this fund. And, of the 3,000 people that were there, only one person invested. Whoa. One guy sent me about $500,000. And about a year later, I think he got $5 million back. But that was it. But it shows you like that very few people, they're trapped in the bubble. And even though they were part of it, they still couldn't see it. Well, like the bubble that we have now is much, much bigger. And it's a lot broader because it's not just housing, because home prices are actually more overpriced today than they were back in 07. They're even less affordable than they were then. But it's a bigger bubble in that we have a bigger stock market bubble than the stock market bubble that popped in 2000. Well, the AI-related names, the hyperscalers, the companies that are fueling the demand for AI, right, they're a big part of it. But the overall market is more expensive than it's ever been in history.
Yeah.
So you have a stock market bubble bigger than the dot-com bubble. And I would, you could throw crypto in there that didn't even exist. That entire industry is a bubble. So throw that in there. But crypto, stocks, and bonds, the bond bubble has already popped. But
can you explain that to people out there who don't understand that at all? Like don't understand the bond market and how it works?
yeah, and when I talk calling something a bubble, it's when the prices don't really reflect the fundamentals, reality, right? The prices are become completely divorced from the economic fundamentals. So with stocks, it's when the prices, if you look at the earnings of the companies, the dividend yields of the companies, and other metrics, the price that you have to pay is very excessive.
That's right.
And it reflects optimism. The crowd is very excited, and they all believe that earnings are going to really grow. And generally they're wrong when you have that kind of mentality. And the same thing, with real estate. I mean, one of the reasons I also knew that real estate was such a bubble was because I would compare the price of real estate to the cost of renting. And renting was so much cheaper back then.
In like 06, 05.
Yeah. I mean, I remember I was still living in Connecticut. I had recently gotten divorced, and I was renting an apartment in Stamford, and my rent was about $3,000 a month. I had a really nice place. I was on the top floor, so I had like a duplex. I had my boat right, below me. I could see the dock. I kept the sailboat there, and it was a brand new building. It had concierge. It had gym. It had a lot of stuff. And right next door there was some old townhomes, and nowhere near as nice as the ones I was renting. But they and I went there because they had like open house. So just for fun, it was right next door. So I went in there. And I think they were selling these things for $500,000 or $600,000, the units. And they were smaller than the one I was renting. Not nearly as nice, not as nice a view, kind of dark, none of the amenities.
The current speculative mania spans a landscape far broader and more dangerous than the 2000 tech bubble and 2007 housing crash combined. Residential real estate has reached unprecedented levels of unaffordability relative to traditional rental costs. Meanwhile, equity markets trade at extreme valuation multiples driven by irrational exuberance over artificial intelligence hyperscalers and unsustainable corporate earnings projections. This environment of unbacked speculative excess mirrors the toxic lending mechanisms that fueled the subprime meltdown. Wall Street's desperate hunt for yield previously spawned teaser rates, adjustable mortgages, and widespread securitization fraud, leading directly to institutional collapse. Today, those distorted incentives have infected the entire financial system, spanning speculative cryptocurrencies, while the sovereign bond bubble has already burst. Artificially low borrowing costs create massive resource misallocations that cannot be sustained. True stabilization requires allowing natural market discipline to clean out bad debt, dismantle speculative excess, and restore sound valuation standards across all asset classes. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.